Turning back now to the economy here and abroad, Germany's approval of a plan to expand the European Rescue Fund sets the stage for additional steps needed to bring an end to the debt crisis. We put together a taking stock think tank to look at Europe's latest move and how it could affect markets and banks there and here. Vincent Truglia, Principal and Managing Director of Global Economic Research at Granite Springs Asset Management. Doug Borthwick, Managing Director and Head of Forex Trading at Faros Trading, and Henley Smith. He's Chief Investment Officer at Commonwealth Asset Management. Thank you, gentlemen, all for joining us. Raise your hands if you think today's vote accomplished anything in Germany. Anybody think? Well, there's some optimism, Doug. Why?
I think it moves us on to the next step. 2 weeks ago, if you thought, would this vote go through and would it pass, the answer would have been no. From the majority of the market, well, it's passed. Every time we've looked at Europe and we've said the EU can't do anything, it seems that when push comes to shove, they do. But politically, I think that you need to look at the chasm before any politician in the EU can really act. And we looked at a chasm last weekend. The World Bank, the IMF, all looked to Europe and said, Germany, you have to do something. Germany's now acted, and now let's look at the next plan. What's the next act?
Yeah, but isn't that the important thing, Henley? They voted today, and they expanded the bailout facility, and markets are already saying too little, too late.
Well, I think that markets are going to continue to demand more and more and more out of this process until we get to the point where we're through that last hoop of fire and we understand what the actual outcome's going to be. I think the market's really suffering from a euro fatigue at this point. We want this issue to move on. I think I'm a domestic treasury manager and there's a lot of euro power here, but I think really from my standpoint, we really want to get this out, get the right answer and move on at this point.
Yeah, well, Vincent, what is the right answer? How far do you have to go before people will say, all right, we feel safe enough to invest long term?
Well, frankly, I don't think we're anywhere near solving the European sovereign debt crisis. And I think the most important thing that happened with the German passage of the new law is that from going forward, all new bailouts and all new extra money must be approved by the Bundestag. Special committee of the Bundestag. So you no longer have just senior politicians in Germany making that decision without resorting to Parliament.
Yeah, well, the Finns did the same thing, put the same conditions on it going forward. So we're still in a situation where you're going to have to keep looking at those chasms, aren't you?
Well, somewhat, but there are other opportunities for investment in the European area. The EFSF is only one part of this so far. There's obviously the IMF and the BRIC countries are looking to do something once Europe gets its act together. Now, the definition of gets its act together hasn't really been made yet.
Yeah, that could be very expensive.
The key word they all used was tackle this crisis, which means there's been a discussion because it's been used by every BRIC country finance minister, tackle the crisis on their own. And we look at key words that are used by these individuals. There's also the ECB. What can the ECB do? We believe the ECB probably before or at the October 6th meeting is going to increase the LTRO from 90 days up to 1 year. That's going to make people now stop looking at the very short term for the banks in Europe and maybe look at the long term. One thing that I think is maybe misunderstood is that people call this a euro crisis. That's a European financials crisis, but not necessarily a euro crisis. The euro is actually up on the year from year to date versus the dollar. And people don't really understand that European financials are actually down less. Deutsche Bank is down a lot less right now than Bank of America is for the year. Deutsche is maybe only down 27.5%. BofA is down 52%. Is this really a European crisis, or is it a financial crisis affecting everyone? But it certainly necessarily isn't really a euro crisis. Well, the euro is actually up over the past week.
One of your competitors made that point today, saying in 2012 the euro is going to be stronger, if there's a euro. The thinking seems to be these days that one way or another, Greece is going to have to default. Vincent, you say it's inevitable.
Yes, it's absolutely inevitable. The only question is the timing and how orderly or disorderly it is. If they get the money from the latest package, then we're going to be dealing with the same problem in the next 3 months.
Is it disorderly? We know it's coming. Can't they craft a plan to bring them into a soft landing?
That's going to be politically determined, and that's very difficult to predict. My bet is that it's probably going to look more disorderly than orderly, but it'll probably follow the Argentine example because people will wait to the very last minute and then things get out of control and you get a meltdown.
Well, Henley, one of the more fascinating stories I thought overnight was this story in the Financial Times that bondholders are all upset that they might have to take a bigger haircut. We discovered that we invested in risky assets, and my goodness, they're risky.
Yes, absolutely, and open your eyes and continue to move forward. Now, I think there are a lot of complex problems playing out here politically, socially, financially, and we're looking for simple answers, and hopefully a simple answer will emerge. But I continue to be very positive on the Eurozone moving forward in the future, and my only reason there is the year 1989. And I think that Germany, for one, understands how destructive division is, and I do believe that they will stay together and move forward and find the proper answer to go that way.
Well, you're talking about a simple answer. One sort of simple answer has been proposed, Doug. You and I have been talking about this. It's called the Berger Plan, put together by a consultant to the German government, but we don't know whether it's an official German plan or not. Depends on who you talk to. But essentially, it would have the Greeks take a bunch of state assets, put them in a special purpose vehicle, essentially probably run by European Investment Bank, as collateral and take loans against those.
Yeah.
Well, you think it will work. A lot of people think it's a crazy idea.
I don't think they wouldn't take loans against it. This 125 billion they're talking about would be used by Greece to buy back their debt and move it from 150% debt to GDP to around 88% debt to GDP. And from there, then kind of move forward with, and that's a lot more manageable for them to pay. It's interesting. It's very elegant in that the way that it was written. There's a number of things I found very interesting. One, they talk about how this would really crush the CDS holders. They want to go after the speculators. This is something that the Austrian finance minister said last week. She wanted to go after the speculators. There's a number of people that have talked about CDS in the market these days and really getting out at these guys that have been buying CDS, which pushes down obviously the local debt, which then hurts all the financial companies within Europe. So I think that there is sort of a plan afoot either in the CDS market, but certainly this Berger plan seems to be taking more weight, especially as the European Investment Bank today just shelved for a debt offering in the United States.
Well, one quick question about this before we have to take a break. And according to the Berger plan, you put 150 billion euros into this SPV, but they've only identified 50 billion in property they want to sell, and they don't say when they're going to sell it. Isn't that sort of the mother of all prepayment risk?
Well, this is obviously the problem. Is there 125 billion of state assets that Greece wants to give up? Now, if there is, and they do want to give it up, and maybe that's what Merkel talks about all the time when she talks about Greece being serious and Greece stepping up. Maybe it's not about them, firing some public sector employees. Maybe it's actually about selling state assets. Now, this obviously isn't something that's in the public right now, but obviously we'll find out as days go on.
Doug's enthusiastic. Do you think that would work?
As long as they, in my opinion, come up with a plan, stick to the plan, and get it into the markets so we can deal with it effectively. I think this death by water torture, which we seem to be going through, and I understand that there are a series of scheduled fire hoops that we have to deal with and jump through. But in my estimation, looking at this from 30,000 feet from a very macro viewpoint, as long as there's a credible plan on the table, one that we can deal with, one that we can digest and move forward, I think the markets will accept that and be happy about that.
All right, Joe, we were talking during the break about the economic numbers today. Minor numbers, but they had a major effect on stocks because everybody, I think, is expecting a recession, or that's the talk, and all of a sudden you get some data that don't quite agree with that. Vincent, where does it leave you after today?
Well, I don't think the numbers really were very significantly different than the earlier estimate. And from my point of view, I think consumption will become weaker as this year proceeds. And more importantly, I'm more worried about what happens in 2012 if we don't see an extension of the payroll tax cut, and if the super committee doesn't come to an agreement and Congress passes it by the January deadline. And I think increasingly, given the politics in Washington, that is a risk. And so 2012 is greatly at risk from my point of view.
Well, that hits the old uncertainty question, and yet in the GDP numbers, minor as the revisions may be, business spending rose.
Yeah, and again, you get to the point where this soft patch, which became a quicksand patch very quickly, the market psychology was just so negative. Even numbers that are mildly positive, I think, take on a new meaning at this point. And I agree with Vince that the political rhetoric is just going to increase. What we saw in late July, early August on the debt ceiling argument, that's just going to be notched up a tremendous amount as we get into this presidential political cycle. So I think there's going to be a lot of volatility. I think we're all going to agree the market volatility will continue to rise. But I continue to be positive on the job side, because I do think, because it is a presidential cycle, an election year, I think that the administration, as well as the Republicans, are going to do what they can to get those job numbers up.
Well, speaking of a presidential election and economic controversy, the Fed's certainly been the whipping boy for the Republicans. Do they continue on their course? Are you reading into Ben Bernanke, Doug, that he is going to continue to ease policy if he can?
Well, I think he will if he can, I think is key. I think that if the ECB doesn't step up with some sort of easing cycle, then I think that the Fed would be forced to in the United States. I think that if the ECB does nothing and Bernanke does nothing, then what you're going to have is you're going to have a very strong dollar. You're going to have a rush into the dollar, and the euro would go lower. And U.S. manufacturing depends on that weaker dollar. And you see what happens these days is as the euro goes lower and the dollar gets stronger, stocks go down because multinationals export abroad. Brazilians nowadays, looking at a U.S. good from a week ago, they're paying 22% more from a week ago, just because the dollar against Brazil has rallied so much. Now, personally, and our firm, we believe that the euro is going to rally from here, the dollar is going to weaken from here, in line with Obama's view that he wants exports to double over the next 5 years. So, in our scenario, you're going to have a weaker dollar, you're going to have a higher euro, stocks will then rally and come up with that, and we'll export our way out of this crisis, because certainly cutting rates further isn't going to really help things.
No, but certainly a lot of people conflate the stock market and the economy. That might help. One thing I want to ask you, because you focused on this a little bit, speaking of the Fed, they've been talking about specifically over the last couple of days, more regulation of money market funds. They're also looking at what's happening in Europe, where the money market funds are pulling money out of Europe.
Yeah, again, and that's our focus is liquidity management. Money market funds is really where our niche is. And yeah, that's really been the Achilles heel here. And I think the Boston Fed president came out and looking to put more curbs on money market funds, so that really chink in the armor that happened back in 2008, which really kind of came out of nowhere. They want to make sure that doesn't happen again.
Because the hot money can come right back out. A fund manager can say tomorrow, I'm going to take all that money back.
Absolutely, and people look at money market funds as riskless liquidity, and if that riskless liquidity is put at risk in any way, that's going to seize up and really cause a cascading problem.
Well, visit the financials before we go here. What kind of shape are they in? We saw a rally today. Would you invest in them now? Is it time to turn that around?
Well, fortunately, as an economist, I stay out of the business of telling people how to invest their money. But clearly, the Fed is doing everything possible to improve the capital position of banks. I mean, just given zero short-term interest rates and long-term rates being higher, if you're a bank, definitely you should be able to make money on that. The problem you have, though, referring to the earlier point, is comparing the U.S. to the Federal Reserve to the ECB. The ECB is in a terrible bind because they only have one mandate, and that's to control inflation. And German inflation has accelerated. So the ECB is under pressure to, if anything, to keep rates where they are, if not to raise them, given their mandate. But they know for the health of the financial system in Europe, they probably should be lowering rates. So fortunately, we have a dual mandate, which basically means the Federal Reserve can do whatever it wants and justify it. And thank goodness it can.
15 seconds. Does the ECB cut rates next week?
I would think they probably will, because they're so afraid of what's going on in the market. But again, how do you justify that given its mandate? A real problem.
A lot more uncertainty ahead. Thank you very much, Vincent and Henley, Doug, for being with us today.